Good morning, everyone. Welcome to our part 3 of our lecture series in entrepreneurship and venture capital. As you know, we had 2 guest speakers in the last few weeks. Now we are pleased to have, so to say, the highlight of our guest speakers, Professor Fidelio Tata from ISM University in Berlin. We need to switch on the light, please. Can you help us? Thank you. Good, excellent. So, Professor Tata speaks the same language as me, not just German, but also derivatives. He's going to speak about real options. As you know, in this class, what we did in the last few weeks is we tried to study and learn how to value companies, in particular startups. That's the part here. We learned about DCF, how to use DCFs in perhaps finding out the value of a startup. Then we looked at the venture capital method. And real options, which is one of the areas of expertise of Professor Tata, is another way of potentially finding out whether a startup or perhaps a project within a company is valuable. So over to Professor Tata. It's all yours.
Thank you very much for the kind introduction. Thank you very much to you, the audience, to allow me to speak here. Obviously, I'm a professor in Berlin at the university over there. And for me, it's a great pleasure and an honor to be here for the week and be able to give some lectures. So before we start, I just want to say a few words about myself so you know whom you're listening to. I grew up in Berlin, Germany, and I went to school, university in St. Gallen, where I studied finance. And then my first job was actually in Zurich with JP Morgan, American Investment Bank. And after a year, they allowed me to move over to New York, where I spent 17 years on Wall Street, basically covering institutional investors, mostly in the area of derivatives and fixed income. And some of my main clients were hedge fund, which are particularly sophisticated when it comes to trading. Then I came back to Germany. First I was a consultant, and for the last 6 or 7 years I'm a professor now. And my focus is indeed financial markets, including derivatives, also as of lately blockchain technology. But I'm still at heart, I'm a derivative guy. So today I'm trying to create a little bit of interest on your side for the world of derivatives and how derivative thinking or option thinking can help you to identify value and to be better in your area, even though the entrepreneurial area, very often you don't hear that much about option pricing, but still I'm going to show you that there are certain aspects of option pricing that could be very relevant to you also. So interrupt me anytime if you have questions or you want to discuss something. I can switch gear and talk about completely different things if you want to. So don't hold back with any kind of question. So what I want to show today is just give you kind of a motivating example of why looking at optionality makes sense. Then discuss certain type of options you find in the real world, so-called managerial options. Then we're going to do a small case study together where we're actually going to calculate something to find out that having an option later to decide what to do can be very valuable, even though it could cost money initially. Don't worry, we're not going to use some sort of option pricing theory, Black-Scholes, that kind of stuff. Very, very simple cash flow analysis, and even that will illustrate that. But before we start, I just want to give you kind of a option pricing theory 1.0, and it's not even 101, it's 1.0, because it basically is the most basic thing. If you basically ask me, I only have like 30 seconds in the elevator, and in the elevator I need to explain to someone anything about the option pricing. How can you do that in a few seconds? And that's what I've done for you. And I basically when you take a course about option pricing, then it's a whole semester, and you go into analytics, and you learn a lot about all these different factors that go into the pricing of options, and what model and so on. But if I had to condense it into basically 30 seconds, I would tell you, take away those 3 kind of informations, and believe me, they are true. These 3 type of information, which you then can use on an intuitive level without even using formulas. The first one, the value of an option is always 0 or greater than 0. An option always has value. I mean, it seems trivial, but it's not necessarily understood that way. So for example, if you're in a high-rise building, this is not very high, but in 10th floor, 20th floor, the option to jump out of the window has some value. So if I tell you, I give you the opportunity to jump out of the window, 10th floor, to kill yourself, most people would say, I don't want to have that kind of option. Leave it, keep it for yourself, right? So you go into a hotel, you're on the 10th floor, and you see you cannot open the window because they blocked it, and another hotel allows you to open the window. Then the hotel that allows you to open the window gives you an option, right, to jump out of the room. Right now you would say, well, this option is totally worthless, I don't want to have it, I don't care, hotel A, hotel B, I don't care. But that's wrong, because you make the decision based on today's information. Today you don't want to jump out of the window because you don't want to die. But a week from now, who knows, right? Who knows? Maybe you're terminally ill and you want to shorten your life. Maybe the house is on fire and there's actually a chance that the firefighter will save you when you jump into a net or something like that. So you never know what is going to be valuable in the future. That's why an option is always valuable, right? So if someone says, you want to come to a party on Saturday, you decide, don't say no now, wait, because you never know. Maybe on Saturday you want to go. Options always have positive value. That's rule number one. Rule number two, time is your friend. The more time you have to decide, the better. Why? Because if there's more time, there's more uncertainty, more things are going to happen, and therefore there's a higher probability that maybe you want to execute the option. So an option that runs for a long period of time is always worth more than an option that expires very soon. Okay? So that also is something people often underestimate. When they say, oh, I get an invitation to a wedding a year and a half from now, they say, this is, I don't want that kind of invitation. I don't know what I'm going to do a year and a half from now. But it's a good option because you don't know what you're going to do a year and a half from now, so it's actually very possible that you want to go to the wedding. More so as if the wedding is tomorrow and you already know you probably don't want to go. Third thing, volatility is your friend. The more volatility, the more uncertainty, the better. If you have an option to do something, you hope for uncertainty. So if the hotel gives you the right to cancel the reservation, for example, you have a trip coming up in 3 weeks' time, the option becomes valuable if there's a lot of uncertainty. You don't know whether the trip is going to happen, whether you're going to travel or not, things like that. Because then you have the maximum power to make the decision later on, and that gives you maximum value. So a lot of people say, I don't want that kind of option because it's too uncertain. That's a wrong answer. The more uncertainty, the better, right? So these are three things. We're going to fall back to these simple valuation rules every now and then during my talk so that we avoid having to plug in some formulas and calculate it formally, right? But these are the kind of rules, and I would encourage you to keep them always in the back of your mind when you go through life, when you come to a situation where you have a choice to make. These things help. It's always good to have the ability to make a choice. It's always better if you have long time to decide, and it's always better if the environment is uncertain. All right, so now let's start with some sort of motivating example why sometimes the intuitive thinking is not giving you the right answer when it comes to evaluate opportunities in the market. So let's say, for example, look at this picture, right? And it's actually a picture from Chicago. It's already a few years old. And on that picture, you see several things: street, parking lot, there's a high-rise building, there's a smaller high-rise building here, there's a church. Now, if I ask you, you can pick anything on that picture, right? Any part of this picture. I give to you for free, right? You can pick. You cannot have everything on it, but you can pick something on it. What would you pick? What would you take? The high-rise building, the church, a small building, the parking lot. What do you take? So, what do you think? Let's take a vote here.
The parking lot.
Sorry, parking lot?
The parking lot.
Also the parking lot?
We take the building.
The building. Okay. So it's already you're already kind of a sophisticated crowd, I can tell, because a lot of people say parking lot. That's not the intuitive answer you get if you ask people on the street. You ask people on the street, most people will tell you, I take the high rise. Am I stupid or what? Do I want to tell my friends I'm the owner of a parking lot? Who cares? No, but I want a high rise. And most people would probably, then if you push them to explain their decision, argue from a cash flow perspective. They will say the high rise building, maybe it has some debt, it probably has a lot of fixed costs, but it's not a lot of rental income, So maybe on an annual basis, it creates a profit of 10 million or 20 million or something like that. So annualizing that for the next 100 years, I'm a billionaire if I own that thing. Parking lot. Look here, I mean, it looks like you can drive into the parking lot even without paying. Maybe it belongs to the church, they don't want to charge for the parking. So the cash flow is basically zero cash flow coming in, and you still have the cost, you know, to clean it and stuff like that. So that doesn't look like a good cash flow perspective. But some of you already said, like, they still take the parking lot, so why? Can I ask someone who said parking lot why?
I can invest the parking lot because it has a land and build 4 high-rises or 5 high-rises.
To build your own high-rise where the parking lot is. Exactly. So you could say, well, the parking lot gives me the opportunity to build a high-rise. Okay, so I could build this kind of high-rise myself here. But if I tell you, you can have the high-rise, why do you take something where you still have to build it, right? Here it's already built.
Because I can build more than one.
Yeah, you could build a higher one, for example.
Yeah,
So we're getting exactly where we want to get, because this parking lot, is one more answer?
No, I think it's also because it depends on who has the parking lot. Like if someone has the capital to build a building like that, then obviously it's more valuable to them. Plus, with it being such a prime property in a prime area like Chicago,
Yeah.
the asset can be flipped probably easier and faster than the building can, because it's just like more, you know, agile. There's nothing built there, right? So it's more, I think, more of an interchangeable asset than say a building would be, even if the location is very similar.
Exactly. So the parking lot gives you more options, more opportunities to wait, to build maybe later, to build something higher, to, you know, do whatever you want to do with it, while the high rise is already there. It's very hard to demolish a high rise and build something different or something larger or smaller once it's there. And that's exactly the answer. It turns out that this piece of land in the year 2017 was sold for 110 million, and that was actually the most expensive property without anything on it ever sold in the United States up to this point. Although it's something that has nothing on it, has no positive cash flow generation right now, and it still was sold for that tremendous amount. And what that proves is that you cannot have a proper evaluation. Now this is evaluation by the market, right? So the market, you know, whoever people, you know, bid for that, they had all kind of evaluation technique, not just net present value, but probably also some option pricing and whatnot involved. So if you have a very simple way to evaluate things just based on the net present value of the known or the expected cash flows, most likely you would not be able to justify it to yourself to pay 110 million for a parking lot. But you will see, you get there if you're able to incorporate in your pricing these aspects we just discussed, which is that you have the flexibility to wait until the housing market is even stronger and then build maybe a skyscraper that is twice as high as this one, or maybe there's a financial crisis and you don't build the skyscraper now and you wait 5 years. So all these kind of things are basically part of the value of the parking lot, and you have to kind of incorporate that into your evaluation technique. Otherwise, you will never end up with 110 million, or maybe you bid 10 million and you wonder why you cannot buy it. Someone else is bidding more. So there are optionalities associated with the parking lot. The parking lot itself has a negative cash flow. The cost currently is higher than the revenues, because revenues are basically zero, right? And still it has a value. So where's the value coming from? It's coming from basically some sort of options. What is an option? We already identified. It is the option to delay the development, the option to wait, right? And why it makes sense to wait? Because maybe today you would build a 40-story skyscraper, but maybe 10 years from now you want to build a 80-story skyscraper. But once you build a skyscraper, you cannot just change it. So therefore, sometimes it's better to wait a little longer to find out what is the optimum point in time, what is the optimum technology given to you to build maybe a higher skyscraper, things like that. And that option value is part of the parking lot. You have the parking lot. And parking lot, of course, is nice because you can always, you know, tell the cars to go away and then you start building. If you already have a building like this, first you have to throw out the tenants, right? That can take years and years because they don't want to vacate the building. So sometimes better to have a negative cash flow, but you have the ability to turn it into a positive cash flow like very quickly, than have something that has a slightly positive cash flow, but you're never able to change that low positive cash flow. So these are the kind of, these are the kind of ideas we are now trying to evaluate or to think about, because when you think about the entrepreneurial world, where there are young companies who just enter the business, very often what they're creating for themselves are options. And we're going to see what kind of options they are, and you have to take that into consideration to proper evaluate the entrepreneurial startup, or else you don't see the true value. Right? And by the way, this is the reason why people who don't know anything about startups and venture capital and so on are always surprised that small companies that has just recently being established and have very little cash flow and have no profitability still trade at a high price. Right? This you cannot explain with like the current cash flow. You have to do a little bit better than that. So how are these options? How can we look at those options? Now let's take a textbook approach. In the textbook, of course, I always try to kind of be formal and find different ways to separate an area into subtopics. So these kind of options, in the textbook they're called managerial options. So why managerial options? Obviously they're not financial options, how to price a call and a put in the financial market. That's a completely different thing. You have courses for that also, option pricing theory, and you learn models like Shaw's and how you can use them to calculate financial market instruments. But that's not what we're doing here, obviously. What we're doing here is to evaluate options in real life. And these are not options like whether you want to go to the party, rather options within a corporate setting. So therefore they're being executed by the management team. The management team has to decide, should we take one action or another. So therefore they're called managerial options. And there are many different types of managerial options, and there are different ways to split them into different subtopics. But here are a couple of examples. The option to grow the business, which is an option to increase production. That's not a trivial thing, because very often in an entrepreneurial setting you start very, very small, maybe in a small village, you try something out and you find out it works very well. Yeah, it works very well, but still no value, because in a small town, if something works very well, you make a few $100,000 or $1 million or something like that. So venture capitalists would not want to throw in 50 million into something like that. But the venture capitalist is asking for, is it scalable? Is this business model scalable? If it works in this little town, will it also work in the big town, and will it also work in different countries and different continents? And if you can prove that this is possible, then the success in the little village is actually an indicator of a business that could be valuable a lot. So the scalability. So that's why one of the first questions, and you know that better than me obviously since you're studying this field, is when you ask a VC firm or a venture capitalist, what is one of the first questions they ask, any kind of business? It's not, how profitable are you right now, or what is your revenue, stuff like that. Rather, is it scalable? Because if it's not scalable, forget about it. It's a waste of my time, right? Only scalable business counts. So the option to grow business is valuable a lot in this kind of setting. If you can demonstrate that you have the ability to grow it, to increase it. And not only because you can increase it, but also you can grow it if and only if it's successful. So it gives you a limited downside, because if it doesn't work in the little town, you stop. But if it's successful here, you grow it a little bit. If it's still successful, you grow it. So you only grow it, that's why it's an option. You don't have to grow, you don't have to make a decision beforehand, you can do that over time. Option to reduce business is also very valuable. That's basically the ability to pull the plug, to say, I want, do less, scale down. Now, for example, if you have a franchise business, it's easier to do so, because the number of franchisees you're accepting, you can basically play with that number and scale it up, scale it down. If it doesn't work so well, you scale it down. Option to delay business, this is also very valuable. This is an option that you can do something, but you decide when. Now we go back to our option pricing theory. Time is your friend, so to delay something is good, because you make the decision later. Usually people say delaying things is not good, and then some smart professors will tell you delaying is not good because it's further in the future, the profit is further in the future, and the net present value of something further in the future is less than something that is not so far in the future, assuming positive interest rates. Yes, that's true, but that's a little bit like focusing on the second order effect, when the first order effect, the more bigger effect is whether you have a large profit or small profit. So it's better to have a super large profit way in the future than a small profit now, even though you have some discounting going on. So don't, discounting is important. I don't want to tell you not to discount, in your little spreadsheet when you discount cash flows. In our environment, where the discounting rate is 3%, 4%, 5%, not going to make a huge difference, but you look like an idiot if you don't discount. But what's more important is the number you're discounting. So there's no point, to say, okay, I'm predicting a cash flow in 10 years' time, and I have the absolute correct interest rate, and I'm doing it properly, quarterly discounting and stuff, semi-annual, and I have the right formula, and this is only a fraction of a year, so I account for that. You look very smart, but only in the classroom, because in reality that doesn't make a huge difference. But if you have the wrong number you're discounting, then it doesn't matter how accurate you are in the discounting procedure mathematically. So always keep that in mind. So with an option, you have the right to decide when the cash flow is happening, and you will pick the right point in time and generate a much larger number at this point in time, independent of the discounting. Right? So this option to delay business is very valuable. So if, for example, the company applies for a license from the government to operate something for which you need a license, like a nuclear power plant or something like that, it's great to get that license, for like 10 years, and you decide when to start, next year or 5 years from now. Instead of the government saying, okay, I give you the license, but you have to start within 12 months, right? So this is already kind of, when you have these kind of rules in the back of your mind, time is your friend, this is a very helpful thing during negotiation, because very often things are not just given to you, they don't fall from the sky, you're in negotiation position. So for example, you're negotiating with this little town, when, we get a license to do something, how long is this license good for, right? And they say, well, you start now, right? Within a month or no. They say, can you make this license good for like 5 years? And we decide when we start. Maybe they say yes, because they don't really understand what they're doing. And that way you created an option for you. And you didn't even pay for it. And we know an option is always larger than zero. So if you combine rule 1 and 2, you just increase the value of your activity as a manager for the company you're working for. And then finally, option to abandon the business. This is also extremely valuable option. This option is actually created by the lawmaker in pretty much every country in the world, I know at least. How do you call that kind of law or the rules in a country that allows you to walk away from business activity? To just say, okay, I'm sorry, I'm out of here. I'm not going to pay for anything after that. How do you call that?
Exit.
Sorry?
An exit.
Exit, yeah, but it has a certain name. What do you do? What do you file for if you basically...
Bankruptcy.
Bankruptcy law. This is a great thing. People always think of bankruptcy as a bad thing. No, it's a perfect thing. It's a good thing. It's an option. It gives you every day of the life of doing business. You have the option to say, I continue, which you probably do if it's a profitable business, or I file for bankruptcy. Why? Because once I file for bankruptcy, my personal wealth will no longer be affected. Right? It's kind of a stop loss for me. Otherwise, I will take your house and your car and everything, your savings. Do you like that? No. It's good to have this kind of option. Right? Again, be careful. People say, oh, this option, my business is good. No, it's an option, and an option has a value larger of zero. No matter how successful you are, it's always good to have the ability to declare bankruptcy. You don't have to do it, right? You're free to decide, but it's better to have that option than not to have it. Right? So this kind of abandoning the business option is very, very valuable. Very, very valuable. Now in some countries it's more difficult than in others. That's my personal feeling is companies are not so keen to invest in France and Germany because it's actually very difficult to get out. It's already difficult to get in, to get all the licenses, and then you start building a factory and you hire people, and then before you know it, it's almost impossible to scale down, right? They don't allow that. The labor laws are very tight, all that, so you're basically stuck with a business, right? So you don't have that option. Having that option is a good thing. So these are different type of options you can think about. You can think of other options. There could be option on an option, what we call compound option, the option to do one thing and then change it to something else later. So the life, the true life, of course, is much more complex than a textbook or even a financial option pricing theory will explain. So you have to kind of dumb it down to kind of simple optionalities, because otherwise it will be very difficult to evaluate what they're worth. All right, so now I want to give you kind of an example of an option to grow the business. We just talked about that, option to grow the business. And it's an illustrative example. I made it up. I think it's plausible, right? It's plausible, it could have happened that way, but all the numbers are totally made up. It's just for illustration purpose. So go back to the time when there was no Windows. You don't remember that, you're too young today. There was a time when you opened your computer, you see like a blinking dot. That's all you saw, nothing else. Then the computer was waiting for you to type something in. You type something in, dir return, which is a short for directory, and the computer then would show you what is on the hard drive. That was called DOS. Right? Microsoft was like a leader in this kind of language. It's already simpler than using C++ or something else. So they said, ooh, you don't have to be a smart programmer, you only need to know those commands, type them in, then you see what you get. Right? So this was the world we are living in right now, in this example. And then there was a smart guy, Steve Jobs, who came out with his Macintosh computer, and the Macintosh computer was different in the sense that there was no blinking dot. It started off with some sort of window, showed something, like graphical interfaces, and with your mouse you could move around, and was much more intuitive. So Microsoft didn't have that kind of product. So let's go back to this point in time and use it in a room to make a decision. Should we, Microsoft, also mimic what this crazy guy Steve Jobs is doing on a small scale, because the market share was like negligible, really a small company at the time? Should we stick with DOS, which works very well, by the way? Corporates loved it, right? Sometimes even at the airport, you go in the airport and you look at what they do at the computer, it looks like a DOS environment, because they're always typing in all kind of numbers and plus and square and whatnot. You wonder what kind of system is that. So it's very stable, right? Corporations, okay, they can live with that. So you have to make that decision. And now you're looking at the possibilities you have as a company. And what do? You create a little spreadsheet, and you look at the cash flows, and then you look at the different probabilities at which the cash flows are happening, and then you want to find out, does this project have a positive net present value? This is like one of the simplest decision-making rules they're probably going to teach you here at the university. Only invest in something if it has a positive net present value. If all the future cash flows discounted are larger than zero, because otherwise you log in a loss. Why would you do that? Right? So let's do that. So if they do not invest into the Windows, in their Windows system, of course the cash flow is zero, because nothing's happening. No cost, no additional revenue, everything stays the same. This is kind of the baseline. Right? But if they do that and they develop a Windows 1.0, the first version of Windows, then what? Then what? But because we are before it has been developed, we don't know what the cash flow is, so they do some analysis. They say it could be a success, and let's say it's a success with a 50% probability, it makes the company 100 million. Well, let's say they come up with that. And also they make an assumption, if it doesn't work out, it's a flop. We lose all the money of the programming effort, of the advertisement. Many of our corporate customers will be disappointed and so on. This is equivalent of a loss of 200 million. Okay, so this is like a short-term perspective, just this single project, Now, if you give this kind of information to someone who is just familiar with the net present value calculation and the net present value rule, do you think Microsoft at this juncture should have invested in developing Windows, yes or no? If you look at the numbers. 50% chance to make 100 million, 50% chance to lose 200 million.
Not really.
Sorry?
Not really.
No. Because what you do is you kind of probability weight, right? You say 50% times 100 million equals 50 million, and 50% of 200 million loss is 100 million loss. 100 million loss and 50 million here is a negative number. So the probability weighted net present value is negative. So the decision should have been no, right? Okay, so maybe that was the right decision. But no, let's look at what happened afterwards. Because what happened afterwards is, although Windows 1.0 was indeed a flop, actually it was really a horrible product, yeah, it gave the company the opportunity to build a follow-up software. Because remember, you can only build version 2 after you build version 1, right? A lot of companies now see that in, like for example, with electric vehicles, right? They like to leapfrog, like say Tesla, and build a car. The first car they built, the first electric car they built, supposedly be so good as the last Tesla. Of course, that doesn't happen because the first Tesla was not so good either. It's kind of the evolution that makes a car better. And you have to go through the evolution. You cannot shortcut. You cannot leapfrog. Typically, you cannot. So it gave Microsoft the option to build another version, Windows 2.0. But what if I tell you Windows 2.0 was also a flop? Then you have a flop here, followed by another flop. That doesn't make the calculation better. In fact, if you only see it up to here, you would probably say that, see, that's the reason why we shouldn't have done the first version. If the second version creates even more loss. But then what happened is Windows 3.0 that came out, that was very successful. Why? Because finally it worked. Finally it wouldn't crash all the time, right? Which happened to version 1 and 2. So more and more people bought it, and suddenly you have a success. So you're losing money, but now positive money comes in. And you can only get that positive money if you make a decision beforehand to invest into something that's supposedly not very attractive. And then the rest, as I say, is history. Then came on Windows 95, which was even more successful. Then after that came Windows 98, and that's when like the sales skyrocketed. 98, everyone bought it. The corporates, even the end users, consumers, was considered to be super stable, a good product, right? But in order to get there, right, you need to go through the whole cycle. So how do we evaluate Windows 1.0 if you totally ignore these options after it? That would be wrong. Huh? Now I don't know why they went into Windows 1.0 with that kind of logic. Probably not. Probably they thought Windows 1.0 is going to be a success anyway, so by itself this is a good project. But even if you know from the beginning that the first project might not be that successful, it still might be worth a lot to do it because of the options that come and the option to grow the business. Because at any point in time they could have stopped. This option is just something very valuable to any kind of also entrepreneur who just starting the life cycle of the corporation. All right, so here are just now quickly kind of textbook discussions of these individual options. I don't want to spend too much time on it. You can pretty much look it up in any textbook, and it receives the script, I guess, at the end of the lecture. You can read for yourself. The option to grow the business gives you the option to, after you invested, to only increase or the business or keep doing the business if there's a success. Since you're here, you don't know whether you're going to have the success, but this child is here that comes in the future. So this is an option, right? Here you have the option to continue the business or even increase the business if you want to in the future. You don't have to make the decision now. And that value of this decision at this point in the decision-making tree, that's already part of the value for the project right now. Option to abandon business, that is, if you invest, you have the right to abandon, independent on whether it's a success or a fail. Sometimes it's a fail, you still don't abandon, you continue, like in the Microsoft case, because only the third or fourth version is really good. But that decision can be made in the future. There are different types of fails, right? There might be a fail where you say, okay, we fail to generate a profit, but we still have a tremendous outlook for the future. Then even if it fails, you may not abandon, you may continue. If you're successful, probably you continue, but you could also abandon. For example, the company has other areas where you could be even more successful. So you don't want to make the decision now. You make the decision later, and therefore it's a decision to be made later. And because it's in the future, time is your friend. It's good that you don't have to make the decision now. And because the value is larger than zero, this ability to make a decision will add value. And the last one, volatility is your friend. the more uncertainty you have, right? If you're in the business to, I don't know, provide paper to the European Central Bank so that they can print money, that is a pretty stable business, right? You don't know what the inflation is, so maybe they print a little bit more, a little bit less, but you have a 10-year contract, nothing can happen. You don't need much of an option. But if you're in an entrepreneurial environment where the company has absolutely no idea how they're going to be in 1 year's time, 2 years, 3 years' time, these kind of options are key to evaluation. And sometimes the option is pretty much the only value of the whole enterprise, right? Because it has a negative cash flow, you know, it has losses, it's burning a lot of capital, so it's nothing good to be said about it, but it's only, the only value comes from in the future, maybe it can change the behavior or make certain decisions others cannot make because they waited too long. All right, so now what we're going to do is we're going to do a little bit of case study, because nothing teaches as well as doing things for yourself. You can do it for yourself or maybe in small groups of 2 and 3 people together. And we're going to discuss the following situation. So you are an investor or a manager or a venture capitalist or a private equity fund or whatnot who has to make the decision whether to install factory 1 or 2. So there are 2 ways to produce something. You have to make a decision whether you want to go with factory 1 or factory 2. It has to be either of the 2. And those 2 factories are different. This is a small factory. And here we set P max, that means it can only produce 100 units. This is a large factory, and it can produce 200 units. Now, like with all factories, a small factory, of course, is cheaper than a large factory, so that the fixed cost, what you have to pay every year, is only 50 here. For the large factory, it's 80, right? It's a big one, mega factory. The variable cost, so how much it costs to produce 1 unit of a good, is 40 cents in a small factory and 35 cents in a large factory. That's also typical. If the factory is a big factory, it's more automated, more efficient, and therefore the production per unit is cheaper. Right? Now the goods you're producing, you sell, to make it simple, for €1 or 1 pound or whatever currency you want to use. Okay? So now, in a world of certainty, of course, you could ask yourself, well, how many goods do I need to produce? Well, that's the wrong question. You're going to produce as many goods as you can sell. Well, okay, then how many goods can I sell? Well, that depends on what the consumer wants. So there's uncertainty. So the world is not certain here, we don't know. So let's assume there are 2 types of environments later on, once you build the factory. One is demand is 100, and one is demand is 200. Right? So either there's demand for 100 or demand for 200. Now remember, if you build a factory that can only produce 100, you can only produce 100, and therefore you can only sell 100, right? So that doesn't help you, that there's more demand. Here, demand is 100, your factory can produce 200, but you're only going to produce 100. But if demand is 200, then you can go full throttle and you produce 200, right? So what you need to do is, for these different environments, calculate what is the revenue. Well, that's easy because you know the sales price is 1, and you know how much can you sell, what's the minimum of the demand, and what the factory can produce. Then the cost, depending on your cost structure, and the profit. Now there's a profit in an environment where demand is low, and a profit in an environment demand is high. And let's just assume, for simplicity, there's a 50-50 chance. So then what is the expected profit in this when you build factory 1, and the expected profit when you build factory 2? Right? So far there's no option pricing theory involved or whatnot, a simple cash flow probability weighting. So why don't you go ahead and do that? Probably takes you like 10 minutes or something like that.
Give you a piece of paper.
You can do it on paper.
You have pen. Yes. Pen.
Then I'm going to collect the answers, and then we're going to move forward.
So we all do this. Yeah. Good, all of you. That's very good. And